here. Now it's being recorded, so thank you for being here. I'm really excited to have this workshop, and especially during this time that we always have so many questions about capital raises. We are at the end of Q3 almost, right? I'm going into Q4, finishing out 2025. So a lot of you I know are tech founders that are raising money. There is a lot of uncertainty right now in the economy. There's a lot of volatility in the economy. There's just a lot going on, whatever way you're swinging, right? There's just a lot of things that are happening in the public markets that unfortunately gets or fortunately sometimes gets waterfalled into private markets. And that's what we're going to be talking about today. And the insights that I'm going to be sharing today are my own, right? I've looked at Crunchbase and AngelList and all of the data that's possibly out there. And also from insights of talking to startups, usually like more than 100 every single month that are raising money, but also on the investor side, saying VCs and angel investors in the earliest stages that are investing in pre-seed seed. So that's kind of like my view, my kind of like area of genius, right, is right there. So I wrote an article about this. Stephen wanted me to talk about this because we just get this question a lot about, what is it like right now? What's the ecosystem feeling? What are investors feeling? And also, because we have a lot of entrepreneurs in this room, is you're not alone. It is not you. It is really the market that is out there. So I have about I think it's like 12 slides, more academic of some of them are more academic of graphs and stuff like that from Crunchbase. And I'm probably going to get through with it in about 20 minutes, 15, 20 minutes. You can, raise your hand, but I sometimes can't see that. And we will have a great discussion afterwards because there's so much great discussion to be had after you kind of get the whole view of the market. Let me just share right now my screen. Perfect. So there's just so many things that are screaming at me on my screen. So let me present this. Hopefully everybody can see this and put it into full screen. Can people see full screen? I think I can see.
Yeah, it looks good.
Yep. Okay. Perfect. Thanks, Stephen, so much. So really we're looking at an early stage capital kind of view in a post-exit drought. So as everybody probably knows, there has been an exit drought for a while. 2024, definitely 2025. And this is coming out of COVID, right? The long tail of COVID of right when COVID hit, if you were around, if you were not around as a startup founder, a lot of investors just hunkered down and invested or reinvested in their portfolio companies. That's what we did in multiple funds that I'm involved with. The San Diego Angel Conference actually at that time went right into actually doing it virtually. So there's a lot that transitioned quickly. If they were doing something that was access to capital, they kept on that venue or that feel, but they did it virtually, which meant that things had to change through due diligence, like the due diligence processes had to change. There's a lot of change going on, a lot of uncertainty, but either you double down on your existing portfolio and said everybody else, I really can't do it. And then about 6 months, 9 months after COVID started, people started to kind of open up to looking at newer startups. That kind of still feels like what's going on now of a little bit of hesitation, but what I've seen is there's openings in different areas, and I wanted to go through that with you all. So there we go. So the current investment climate is that, there's a lot of unprecedented changes and there's volatile markets and also fickle customers. So I want us to have a view of the climate's kind of volatile. The climate is unknown, economic climate. There's a lot of political stuff too, right? But also customers, B2B and B2C. So sometimes whenever somebody asks me these things, I'm not only looking at B2C, B2B are fickle as well. They're saying, let's hold let's see what our customers are doing, or let's hold because there's a little bit of uncertainty and we don't know. Let's hold because of this. So a lot of people are holding. B2C is like, well, I don't have what I used to have in my bank account, and I need to be more careful on what I spend. So if somebody's a CPG company, it's like, okay, if I thought that my lifetime value of a customer is $100, you might have to estimate a little bit less, right? Maybe $50. If you know that your customer spends about $1,000 on X and you're going to carve out 10% of that $1,000, you need to kind of reevaluate that. So that's what I'm talking about, fickle customers. And founders struggling with tariffs. Investors are navigating that exit drought. A lot of um, early stage angel investors have not had an exit in 2 to 3 years. My last exit was 3 years ago, right? So are we going to get another exit in the next year or two with all this volatility? That's when we said we can't write a next check, or we're more careful on that. But that's kind of giving you the insight of the angel investors I talk to, VCs that I talk to, and entrepreneurs. But it also showcases in Crunchbase and AngelList. So I try to give you as much data as possible so that you are equipped to make the right decisions and to think that you're not crazy. So the early stage investor ecosystem globally has been flat in the last 2 quarters of 2024 and the first two of 2025. Right here, you can see it, right? Total dollars invested. Yeah. Yes. Okay, total dollars invested of 2024 is has gone down, and then it just stays flat in all of these 5 quarters going forwards. This is the number of deals right here, and this is total dollars invested. So there is this kind of slowing of the market, except for AI companies. And I'm always going to have an except for AI companies, but there's also another layer. I've seen in the last 6 to 9 months as well, since the beginning of 2025, a resurgence of being more careful with understanding what AI is being used in a startup, right? It's not just something that's a wraparound. It's large language models. How are they being designed? What is a database? All of those things are really important now. Before it was like, oh, AI, perfect, we'll invest. It's not that way anymore. So just be careful about that. Despite lingering exit droughts chipping away at the trust across ecosystems, there's still cautious optimism when investors see capital conscious growth backed by actual revenue and grounded collaborations. So I'm going to be really looking at revenue. I'm going to go forwards here, make sure that I didn't mess up. Yeah, perfect. So I put together 7 strategies, reshaping early stage capital deployment, meaning also capital investment into the entrepreneurs that are out there. So number one is angels are more careful in activating capital. And we're going to go through all 7 of these. Early stage investors, there's a true barbell strategy. Really, really early, like little barbell that you're like tuk, 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 exercising with, right? Really early stage, they're going to go after those really earlier stage companies, or very much later to reduce that risk. And I'll go into the numbers there too. Number 3 is angel VC hybrids are active again. It's not just angel and not just VC, not going into like, hey, I'm going to go after these angel investors that might not know business models. They do know the business models, and VCs are going downstream. Number 4 is longer due diligence is the new edge, right? I'll kind of go into that a little bit too, is that even though there's longer due diligence, entrepreneurs can actually leverage that, saying, okay, if I'm an entrepreneur that doesn't mind taking a little bit longer and I know my stuff, I have incredible founder market fit, I know my market really well, and I know my customers because I have revenue, because I have to get that revenue now, you can have a really great conversation with due diligence with the investors out there. Number 5 is revenue is greater than hype. Business model scrutiny is in, right? So that scrutiny on the business model, scrutiny on what kind of revenue you bring in, how much are you bringing in? And if you're even a medical device companies, I'm hearing investors and entrepreneurs saying, yes, I'm a medical device, and typically I'm going to look at 2 years out to get revenue. That investor is asking you, how can you bring it in closer to where you are right now? And even if you can only do it in the next 6 months to a year, you have to have that strategy ready to go for that investor. Number six is trust bridges and co-investing are at a premium, right? Because people haven't had exits, they don't have the liquid cash to be able to invest in a company, early stage angel, that's what I'm talking about, right? And they are not depending on, but they are really diving into VCs coming down and making sure that there's co-investments happening so that they can co-invest together. Much more syndication is happening, and I'll go into that in a little bit more deeper later on. So beyond the buyer is rethinking revenue in a volatile market. So these insights emerged, obviously, and wanted to do some careful data analysis to make sure that we understand this upstream effects that are having in the public markets and how they're filtering down and cascading downwards, affecting you as entrepreneurs and affecting early stage angel rounds. So with that, let's go into one of them, the first one. Angels are more careful in activating capital. So you'll see that there's a slower deal pace, right? Angel investors are slowing their deal pace. That means that as they're looking at deals coming in, they're slowing down, being more careful with analyzing the founder, analyzing the team, having, let's say, if they have a funnel, they had a funnel really, really big, they might still have that same funnel, but they're being more careful on who is brought into the first stage and the second and third. And pausing entirely due to lower liquid assets. So some of the angel groups out there are getting defunct or that they are entirely not investing and because of the volatile public markets. Okay. Number two is there's a 41% drop in check writing. Again, I care about data. So this is from NVCA that monitored these things. So reported a 41% decrease in new check writing amongst individual angels compared to Q2 of 2022. Right. So this is probably data that's about like a year older. So just know that that might be even more or a little bit, depending on how that is. But really, there is a huge drop in the actual checks being written. And what I've seen over and over again is the checks are actually smaller. So when we get into that theme at the very end about co-investing, is that if you're going to get one check in, it might behoove you to get two or three checks in. I know that's more work, right, for the entrepreneur, but that is an added benefit, right, of saying, hey, if I co-invest, if I help these investors invest in my company, I might have to ask three investors to equate one check as of like last year. Okay. Reinvestment rate impact is that angels who experience positive exits reinvest about 2 to 3 times the rate of those who do not. And that is coming from ACA, Angel Capital Association report. I forgot to put it in there, but what the where I got it from. And that's about that goes back to 2023. That still is the same. So they are willing to reinvest 2 to 3 times the rate of those who do not. A lot of angels, again, have not had an exit. So know that they are in a drought. So they are not reinvesting in companies because they don't have the liquid assets. Okay. They might have it in public markets. They need to sell public market stock to be able to invest in you. That's a very different wealth portfolio and wealth like mindset than what they had about a year ago. So understanding that angel investors saying, wow, they have to do a lot of rearranging to be actually investing in me at a lower check size that they're typically doing. That's a little bit uncomfortable for them. So the more that you can build trust, we'll have that theme also throughout this workshop. Trust is going to be really, really important. Exit timelines is the medium time to exit for venture-backed companies has increased to 9.8 years, sorry, up from 7.2 years in 2019, delaying capital recycling into the ecosystem. So it's not just hearsay. It's not just like we haven't had exits. Oh, we can't invest in you. And also that they don't have it, so they're not going to reinvest. But also venture-backed companies have increased the amount of time that they take to exit. So all of that is all compounded. Everybody understands compounded interest, right? It's compounded effects on this startup ecosystem. So just be aware of it so that you know that you're going to take a little bit longer. And if you're doing projections of how long it's going to take you to exit, consider this piece of information, right? To say, hey, if I think I'm going to exit in about 5 years, and that might be something that you're thinking about from data or mentoring or advising that you get, from people who've been in there about 5 years ago, 2 years ago. Add those numbers together. You're saying, okay, 7.2 to 9.8. That's about a 2.5 increase. So maybe you want to increase your exit timing by 1 year. And if they're like, oh my gosh, that's too long, you're like, hey, you know what? I learned some data, blah, 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 blah. I increased it this much because I really want to have an accurate view of my projected exit time frame for you, investor, increasing trust, right? Okay, next up, next theme is early stage investors, a true barbell strategy. So they're investing earlier than before. That's that barbell, right? Pre-seed idea stage investments to find high upside opportunities before valuations increase. So because that valuation increase happens in seed and or seed plus, that investor who believes in the founder, that sees founder market fit, that sees revenue generation earlier is going to be like, wait, I'm going to go a little bit earlier because I'm going to see that opportunity, but it's smaller percentage than what they saw before of the opportunity, right? So that's there. And then on the other side is that they're investing in companies that have de-risked their startup, which means they have more revenue, they have more partners, and all of that. And that's that barbell on both sides. The valley of death. Traditional seed stage investments are getting squeezed, asked to perform more. Who's getting that, right? Investor meetings, all of us, right? Show more and gain revenue earlier. And they're waiting longer to invest. Series A or later investments to reduce risk by backing startups with real traction. We're looking at 3 to 5 million in 2025 versus 1.2 million in 2022. Whoever is a CPG company right now, it's like they're wanting you to be at $5 million revenue and even invest in seed stage. Well, how are you going to get there? That valley of death is super horrible, and they're going to wait until you have more traction, and that traction comes from great partnerships that you have, that you are getting involved with more opportunities in an ecosystem, activating more things. I know that's more time on your hands and more activities, but that's how you get to do more with less money. Okay. The barbell strategy has emerged due to several factors. So we already talked about this. VCs are waiting longer to close their next fund. And I'll go into there's data there. An M&A deal transparency as an all-time low, about 18%. So let me go into that. I want to show you this. I think I can increase this a little bit. No, I can't. Okay, so this is from Crunchbase if you're looking at the reports that are out there. So basically you'll see here 2024, it does say about 18% here. So you'll see it 2019, it was really about 31% is that VC backed M&A deals with disclosed valuation. So they disclose it a lot. 30% of them disclose their valuations in that M&A deal. 2022 was a little bit less. Of course, 2021 was the all-time high, but now look at that. 18% are disclosing the valuation. What does that mean? Right? That means that without clear exits, right? Without a clear indication of, okay, all of the exits in the technology industry have this amount of valuation. Oh, we can actually estimate where we are as early stage companies, but without the disclosures, we have no clue, not no clue, but a lesser clue than before on how do we evaluate that at a very later stage. So again, increased uncertainty, right? Increased doubt, decreased trust in the whole system. You see how that is really important, even in where you are right now at the earliest stage. Now, that was like this number 2 here. This top one is VCs are either at their last bit of dry powder right now or in that awkward in-between phase, right? So let's look at this one down here, this graph here. So during this venture contraction era, which we are right now, they're waiting longer to close their funds, on average about 34 months. So that is this number right here, this 34 at the very edge of 2024, right? We have 2005 all the way to 2024. They're waiting 34 months to actually close their next fund. And this is the variation, 24 months to 41. You see how all of this is kind of increased a little bit here? So really, VCs are less bold and more protective of their portfolios, more protective of everything. And this has this cascading effect here, tougher fundraising environment for entrepreneurs and for VCs. Market correction, there's LP limited partner hesitancy. So they're not going to invest in their funds. Therefore, that GP, that general partner, is going to be like, oh, I'm a little bit worried, and they're not going to deploy as fast. How does that affect you? They're not going to write you a check, right? So really, really important is a venture capital deployment is there's a slowdown in that. So again, it's not you, right? It's an incredibly like very hard time right now in the ecosystem. Number three is startups themselves are exiting with fewer months of runway than ever before, similar to, let's say, the M&A information that's not being shared. This one is super important too. You'll see here in this top one here, startups exhausting runway. From 2017, about 4.1 months were between the runway at purchase, right? How much more runway did they have when they were purchased? 4.1, 4.5, 2.7, 6.1, 7.4, 8.5. We are at 5.5 months to be exact, from a high of 8.4 months in 2022. Right. So the amount, and this is share with less than 12 months runway. It's huge. 80%, right, of companies when they are purchased, right, had only 12 months of runway left. And then 5.5 is a typical. Wow. That's like huge. So even the VCs that are kind of looking forward saying, okay, how is it when I actually sell? Is that startup healthy or not? Well, they're not as healthy as before. So that again increases that like volatility, increases that unknownness, and be like, okay, that waterfall effect to that seed stage company is like, well, I'm not going to invest in it because I don't see you going far enough along to be able to get purchase at the right rate. So just letting you know that there's a lot of aspects to this. Okay, up next is angel VC hybrids are active again. And what we're seeing is that we've kind of alluded, I've already alluded to this, that they really are going in and out of their typical frames that they are investing in. So angels are going later stage, VCs are coming down a little bit. And while some are cautiously beginning to scout new opportunities, their approach remains prudent, right? Influenced by the capital constraints of the past 18 months. But there's a success story. I always have to say a success story because I'm a very positive person and I really want to make sure that the ecosystems are thriving. So one of them is the San Diego Angel Conference, Fund 7. So we were able to raise actually over 500K at the very end. I need to fix this. I was one of the fund manager team. We had Amit as our fund manager, as the fund manager. And it was run and led by San Diego State University. So we had over 50 investors, and the capital was strategically deployed into 3 exceptional companies. Now, you would think that, you know what, in this market, did we actually do it? Were we able to actually raise money from small investors? And mind you, these investors are investing $5,000 into 1 unit. So smaller amounts of money. We were actually very successful in getting these angels to get activated with their capital to be able to have a really healthy due diligence process and length of that due diligence that we felt good, decreasing risk, increasing trust, so that those investors invested in the right companies. And what we found was that, and this is just like last month or the month and a half ago, is that we invested in 3 companies: Recoup, Vera, and Seconia Medical. And we invested about 200,000, a little bit more than 200,000. Vera about 100,000, and they also won Audience Choice Award. And Seconia Medical at $50,000 investment. So, and these are all San Diego companies. Sometimes San Diego Angel Conference looks, I mean, we always look nationwide, but wanted you to know that this process of activating capital is not for the faint of heart, right? And it is happening, but you saw that this is a success story because there's a process, there's a long due diligence, there's multiple people looking at it, and there's an increase of trust between investors and between the investors and the startups. What I saw this year as like an investor is that these companies and also all of the finalists that were part of San Diego Angel Conference had a lot more kind of going back and forth with the investor, making sure that the investor felt very comfortable with the information, with the deal rooms were like huge. Deal rooms are typically a set of folders that we put together as angel group or a fund that we need entrepreneurs to put information into it, like your executive summary, financials, legal documents, all of the things that make your company, right? We organize it into a set of folders, which is called a deal room. That deal room is essential for us to write due diligence reports, right? Due diligence reports are like our evaluation of an investment, and that due diligence period right now is taking longer for typical angel investors and VCs because they want to de-risk. They want to make sure it's all okay. And for San Diego Angel Conference, it's a very long, arduous process. But the positive is that it really helps those investors be like, yes, I'm in. I want to invest. So really great piece. I've already kind of alluded to this, is longer due diligence is the new edge. And deals now take about 2 to 3 longer to close compared to 2021, right? The Angel Capital Association report that due diligence, time is now average about 42 days, up from 23 in 2021. So that is a report that's taken out every single year based on our membership. I'm on the board of the Angel Capital Association, and we evaluate all of our angel groups and we ask them all of this information. So this is boots on the ground information that we've gone from 23 days to 42 days. What does that equate to? About a month and a half of due diligence for one angel group. How many angel groups are you talking to as entrepreneurs? 10, 20, 25, 30? What about individual angels? Probably the same. What about VCs, depending on like what stage you're on, pre-seed, seed? That's a lot of people. And 42 days for each one of them. There are overlapped, right? I understand they're overlapped, but just giving you that perspective that understand and be aware that it is longer. It's not you, it just has to be longer. And then also investors are asking for more from founders during due diligence through like increased scrutiny on real traction. We've talked about that already, about more revenue, better traction that is true traction, not winning an award. It's true traction of decreasing customer acquisition costs, understanding your LTV, your revenue streams, your profits, how much are partnerships coming in? Do you have memos of understanding that have dollar amounts in them? You can have memos of understanding, MOUs or LOIs, letters of intent. You can have all those things, but the more that you can get it more robust in there, some more grounding of that information is going to be better for you. And that's true traction. And also increase reliance on AI for screening and evaluation to decrease bias. So know that a lot of angel groups and VCs are using AI to evaluate companies that are coming in. So make sure that you are just not doing something that would not be AI friendly. And if there is something out there, they're probably finding it through AI sourcing. So knowing that is important. Make it. Okay, there we go. I'm going to double down on the revenue is better than hype. So this is a slide that kind of goes down a little bit because I really wanted to show this data here. So $5.9 billion is what has been funded into seed stage companies in Q2 of 2025 based on Crunchbase. Driven significantly by AI, marking the strongest quarter in 3 years, right? But it is a lot of AI. However, seed stage deal count is down slightly, despite funding totals rising, indicating the posture of betting on more substantial traction-based startups, right? So there's a decrease in the amount of checks being written. There's a total funding has increased. And a lot of it, I would say probably 75% of it is AI. So just understand what the industry that you're in, revenue is just going to be much more important for investors, and business model is being scrutinized quite a bit more. So yeah, so this is my talk here. Revenue traction at seed isn't optional as expected, even in the industry that traditionally haven't required revenue until about 1 to 2 years post-launch. So this is some data here, North America venture deal volume through Q2 of 2025. So you'll see that right here is angel and seed, right? This Q1 of 2023, you're going all the way down, 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 down. Q2 of 2025 is about a little bit less than 1.5 K. So you see how quarter over quarter change is negative 15%, and year over year change is about negative 29%. You'll see that early stage right here, boom, 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 kind of stays the same. Later stage, there's that much there, that much there. It's still kind of enough, but not too much. So just wanting to give you that snapshot so that you know that how the let's say venture deal volume is changing over quarters. And I know that there's 3 chat messages, and I'll get to them in a little bit because I think that I have a little bit more time. Trust bridges and co-investing are at a premium. I alluded to this at the very beginning about, and I used some words that I probably didn't define, syndication, right? And co-investing. So syndication and co-investing are the same, but different. So I would say that they are the same coin, different sides of it, right? So co-investing is, let's say, 2 angel investors or angel groups or VCs that in a round, if a round is $1 million for entrepreneurs, they are co-investing in that round. I put in 100, the other person puts in 200,000, right? You're just co-investing in the same company. Syndication that's the other side of the coin, is more about how one angel group or a couple of angel groups share deals amongst each other. That sharing is a little gray, right? So the gray area is sometimes we share due diligence reports. Sometimes we ask people to come to a syndication meeting, which I go to these syndication meetings that have like 100 angel groups involved, and we screen all of these companies. And then the person who leads that makes sure that all the people that came to the syndication call have information about the companies. At Stella Angels, for example, we do mostly syndication with our angels in our angel group. So our angel group is Stella Angels, and we basically have showcases of startups at our showcase, and then we basically show and have our angel investors know the information about that entrepreneur. We're not co-investing in with that angel because as Stella Angels, we do not have a fund or anything like that. We are a network group and we syndicate. We give information. And that giving of the information, that's where the gray area is, that sometimes it's a little bit of information, sometimes it's sharing of due diligence reports. And sharing also has treaties, that we can have treaties with one another or no treaties, right? The treaty is basically, you're not going to sue me if you read my report and I say invest and you invest and you lose everything, right? Kind of thing. We have this treaty that we're like, okay, we're giving you the due diligence report, read it and do your own. So this trust bridges and co-investing are at a premium because there's so much volatility. The only thing that is the constant, not the only thing, but a constant currency is trust. Tremendous reciprocity between you and us with sincerity and transparency, right? That's trust is the most valuable currency in early stage investing, especially right now. So let's go up to the numbers up here. In the annual ACA survey of May 2025, 82% of the respondents rated co-investor alignment as a critical due diligence factor, up from 61% in 2022. So it is almost a 20% increase of this co-investor alignment to be able to invest in another entrepreneur. So I invest money. I tell my investor friend, come over here. This is a great deal. They're going to really increase that trust. The trust is already there, but they're going to increase the rate that they're going to invest in that entrepreneur because of our relationship. So that's important when you're entrepreneurs, when you're talking to investors, that you're saying, who can you introduce me to? If you've written me a check, thank you so much. We're full of gratitude. But who can you introduce me that is in the same field, the same industry, the same thesis? Can you do some warm introductions? That's the way to go. If you have a mentor and advisor, right, that they're mentoring you, advising you, and you have really great rapport, and that advisor either is on your board at a percentage, right, vested over time, please, and they want to do warm introductions, that's going to get you farther, especially because of this data here. And then the rise of co-investing in SPVs. That's really interesting. This is coming out of AngelList, so a different source. AngelList notes a 23% year-over-year increase in multi-group SPVs. SPVs are special purpose vehicles. That means that one person leads an SPV. That means that, let's say me as an investor says, I'm going to put my money in back of this founder, and we're going to open up an SPV that everybody can invest money into one vehicle, one entity. It's usually an LLC. And I'm going to do all the due diligence. I'm going to share all the due diligence, and you're going to come in. You don't have to do the minimum of that entrepreneur 25K, but you can be at 5, 10, 15, 20 $1,000 investment into the LLC. The LLC only invests in that entrepreneur and that startup. AngelList does SPVs on their platform. So this growing trends of consolidating investor efforts into SPVs or syndicates signals that investors seek to share the risk of early stage investing instead of going solo. So if you're talking to onesies, twosies of investors, again, ask them who they know, see if they are a part of a syndication network, if they can warm introduce you to, and you'll get even more better results there. Okay, so to just finish that off, capital is cautious, and conviction grows through community and syndication. Up next, make sure that I have a little bit more time. Beyond the buyers, rethinking revenue in a volatile market. So I think we have a couple more. Yes. This is probably the last one with a bunch of data. So the B2B SaaS churn is real. So SVB is Silicon Valley Bank in Q2 2025 states that B2B SaaS churn rates rose by 11% year over year, meaning that buying cycle, that rate of churn with that entrepreneur, with that startup increased, right? And a sign of budget tightening, even in previously sticky categories. So like, I always think whenever I hear something like this and I have a data point like that, I always go back to the example of Kodak, right? Who knows Kodak from way back when, right? Everybody kind of does, or if you don't, look it up. Well, they didn't want to innovate over time, right? They're like, oh, our people know us. They're going to buy our stuff all the time. We're not going to go digital. That's like, Fuji or whatever, right? We're not going to go down that route. We're going to stay here because we have this down pack. We have stickiness with our partners. We have stickiness with our B2B sales. And they did not do really good on pivoting towards digital. So I know it's like very abstract way of thinking about B2B SaaS churn, but I always go back like Kodak. Would I be Kodak? No, I'm not going to be Kodak. I'm going to be Fuji, right? Where am I going to be, right? So that just helps me all the time whenever I'm thinking about strategies. So number 2 is delayed purchases. In a Gartner 2025 B2B buyer behavior survey, 77% of B2B buyers reported delaying new software purchases. So new software purchases in Q1 to Q2 2025 due to budget freezes or internal approval delays. So again, that like pullback on, do I spend, do I not? Because there's tons of volatility, a lot of things are happening, and I'm going to pull back, right? I'm not going to do new things. I'm not going to purchase new software. I'm going to stick with what I know, but maybe even the stickiness is actually not being sticky there. So everybody's pulling back, right? Just know that. Vendor switching is 60% of B2B decision makers reported switching vendors in the past 12 months due to a mismatch of value, delivery, or pricing up. Why? Because they're like, oh, I'm good. But it's like, whoa, wait a minute. I'm not good. I'm not getting the value that I need. I need it to be a lot more value. Oh, we haven't even been getting that value for the last 5 years. I'm out. Right? So that's about 40, It's up from 44%. So that's again 20% increase, right? In that switching, right, power. And that comes from McKinsey and Company. So over reliance on customer buying power is no longer a sustainable growth strategy, period. Startups are being challenged to diversify revenue streams, deepen relationships, and build more resilient business models over the piece of pre-seed, seed, and also Series A. Okay. And then of course, AI. So while most sectors face increasing scrutiny that we've all talked about, AI represents a powerful, though still unproven, catalyst for innovation economy. I, co-run the AI lab here at Biola University, and we see a lot of opportunity in AI, but it is not slowing down, but just becoming more stringent in due diligence because there's a lot of people that are just slapping on AI. If you're not slapping on AI, you're fine, right? But you will have to do more due diligence on the technology. I would recommend whenever there's like, let's say, I always look at S curves, right? There's like an S curve of innovation is that there's a time period, right? And there's a lot of innovation at some point. That's the S part of it. And then it's like, shoo, everything gets innovated. Everything is just like crazy great. And then it kind of levels off, right? So if you're looking at the S curve, that S curve, whenever it kind of starts doing this a little bit before it goes up again, there's a little bit more like pause. There's a little bit more due diligence. So if I'm talking to biotech companies, tech companies, whenever you're like in a little bit of a pause, I would say, and that goes tactically, is have a little bit more information about your tech stack. So either in your due diligence room, have a little bit more information. Of course, you don't want to, spell out everything, right? For the right investor. And then secondly is maybe have a second pitch deck. You have your primary pitch deck that you're pitching to investors, have a secondary pitch deck that's very technical, right? So that you can kind of go between the two. And if somebody's like, yeah, I'm good, here's your check, you're good, right? But they're like, hey, I just want to have a little bit more due diligence. Can I get a call to talk about your technology? You're like, yes, I can tomorrow because I already have this prepped. I love this quote from Eileen Lee is from Cowboy Ventures is we don't require product market fit or even a fully built product to want to invest in a team. We look for a unique insight into an underestimated category and also pedigree or a vision for a way better solution to an existing huge problem. So hunker down on that. And I leave you with, oh, yes, I have two more things here. Challenges for founders is there's a moving goalpost. Who's feeling that? Like, I think every single person I advise, right? Founders are becoming more frustrated by chasing that new goalpost. Investors are chasing it out. So understand why they're doing it. This was made for, this workshop. Know why they're asking you that. And you're like, how can I risk mitigate that? I can actually get more revenue or a little bit of revenue. See like how I can prove that. Valuation pressure. Investors are seeking better deals and lower valuations in this risk-averse environment. See what other people are doing in your industry, knowing that M&A deals are just, there's not enough information. So they might be a little bit more scared to do that. Get the valuation information and share it with your investors. That's how you can de-risk that. Market volatility, economic uncertainty is at an all-time high, affecting the riskiest asset class. You are in it right now for investors, early stage investing. So the more that you can de-risk, increase trust, you're all good. And so the key takeaways for navigating the valley that we're in right now, focus on revenue. I think I've said it 1,000 zillion times today. Build trust networks, leverage warm introductions, share due diligence, prepare for deeper due diligence, right? For the entrepreneurs out there, be ready with KPIs, realistic projections. Even right now, if you see like crazy projections as an investor, we're just not going to turn you away because it's just not good to see that. And then diversify revenue streams. If you're thinking, oh, I have two revenue streams, I'm going to go all in, put all my eggs in that basket. See, how can I diversify? Maybe bring in some advisors. The Brink SBDC does a really good job of providing those. Come on in, ask the questions so that you can really think about how do I build multiple revenue streams? And that is it, my folks. Okay. Hey Kabir, and now I know who is everybody's in the room. So I have some chat things here. Um, okay. Okay, here it is. Yes, we will be sharing the recording. Oh, yeah. So what are the prospects for seed stage clean tech companies to get funded? And how can we get in touch with Sylvia for follow-on questions? As a lot of people know, book some time with me. I'm an advisor at the Brink SBDC. That's why Stephen, our director, our interim director at the Brink SBDC, keeps me on so I can answer these questions. And you can always book some time with me to kind of go through your individual questions because every single industry is a little bit different. The industry I don't know as much in is CPG, right? But I'm an investor in a lot of CPG companies, so I kind of know that world because of them, and they're killing it. The prospects of seed stage clean tech companies. The clean tech companies is interesting, or any technology company is you thought before you didn't need revenue, right? Or something, right? You got to build something, right? So I know that it's very hard to get revenue if you're looking at SBIR, STTR funding, and NSF, NIH that are all dried up anyways. You don't know if they're going to accept your grant, and you're like, okay, I'm still waiting for a grant that I wrote back in beginning of February. Let's go. So it might be like 2026, but know that there's just longer time frames for anything that's non-dilutive capital. So usually people would be more wanting that and going after those grants. It's just they are dried up. You don't know. Then secondly is revenue, right? If you think that you can get revenue in 5 years, how could you get it earlier, right? Let's say having a pilot with a clean tech company, right? Saying, hey, we do have a prototype. Would you be willing to test the prototype? And then maybe being able to have some kind of agreement with that. And thirdly is diversified funding strategies. So for instance, I invested in AquaCycle, right? So that is a water purification system. And the founder is Oriana Breshner. And at the time that she was going through all of this at the very early stage clean tech company piece, is that she was like, okay, do I get more grants to have to build my next? She was already prototype 1 and deployed, prototype 2 to deploy, not 2, but let's say a true deliverable. She was able to get some financing from a manufacturing, let's say, opportunity, and she was able to do some interesting financing there to be able to pay for that upfront, and then pay it out over a time period. More people are doing that. So, but you do need to have some sort of risk mitigation of something that actually works and you have revenue and all that. Banks don't give you money to anybody. So, but she was able to have that conversation. I would say that if she was not in the environment at that time that did not force her to do that, she would have been like, I'm just going to write another NIH grant. I'm going to ask some more angel money. She really had to be creative at that time. And then she was creative also during COVID. Um, she had to go through that, and she's like, well, I can manufacture actually hand sanitizer. So she actually kept her little team going, right? Doing hand sanitizers. I mean, she's not that at all, right? It's a water purification system, but she was always very nimble. And how do I find more revenue? And investors actually reinvested in her because they're like, wow, she turned on a dime and helped her clients, and the clients stayed active because she was able to give them hand sanitizer. So just think about outside the box a little bit on that. I'm not going to go on. Oh yeah, my Sylvia, I'm Mohan. I am at the Brink SBDC. So and that is housed at USD. So you might have been confused with SDSU, meaning San Diego Angel Conference is now housed at SDSU. And I was an investor there and a on the fund management team there. So maybe that. Okay, Tim says, you mentioned there are a number of VCs who invest in pre-revenue companies. Where can we find these VC firms? So the VCs that are going downstream, we don't really know who's looking at those and seeking those necessarily. So there are tons of lists out there of on angel lists there. If you look up, VCs in whatever industry that you're a part of, clean tech. I know you're ed tech, Tim, looking those things up. And you really don't, their thesis probably because they've have it somewhere on Crunchbase or they have it on AngelList. Don't buy Crunchbase. I'm just saying that you can get a little bit of information there. How I find to see if are they coming downstream a little bit? I'm on their LinkedIn's. If I know that there's a VC that I'm trying to look at, they might be on panels that are more like ecosystem. They might be doing an article about early stage investing, but they're typically Series A. I'm like, what are they doing writing an article on early stage, seed stage companies? So, yeah, so that is how I find out that, but there's not really a list that is like dun dun dun. There's a list somewhere. It's just Angel List, Crunchbase, looking at your industry and doing the trying to figure it out and stuff like that. There's a lot of lists out there that you can slice and dice. Oh, and then the other thing is ask other people in your industry, other startups in your industry to say hey, who's invested in you? Because that's boots on the ground, right? That's somebody that has invested in a company. And then I usually go in and I look at the portfolio of that VC or that angel group, and do I fit that, or do they already have somebody in my space? Ooh, maybe not be that great for to talk to them. Okay, Mohan, I need to meet with you ASAP. That's great. Of course, you can always email me directly. I'm always on LinkedIn. Everybody knows that. And also you can ask the Brink SBDC. You can sign up. If you are not signed up for the Brink SBDC, I would highly recommend it. Then you get me, you get Benton. Benton is also another person who would be Benton Moore in clean tech would be fantastic. He's a clean tech entrepreneur and investor. So if you get involved with the Brink SBDC, you can actually meet with a lot of different advisors, get a lot of different perspectives. So, oh, okay, here. Stephen Flynn, thank you so much. I've found a list here for pre-seed firms just to start. Yeah, thank you, Stephen. That's a link in the chat. And if you're listening to this on YouTube, typically we have it below the YouTube information. And if you don't find it there, always sign up for the Brink SBDC and we can support you in any way possible. Okay, here. Oh, I missed Ravindra. I'm so sorry. I missed your chat, your message. Thank you for these insights. What is the climate for investing in healthcare SaaS for clinical decision support? Okay, clinical. So let me break that down a little bit. So SaaS and healthcare. Let's just go through those two. Clinical decision support. I don't know necessarily so specific a clinical decision support. Let's look at SaaS. There's easy SaaS and there's hard SaaS, right? So easy SaaS are the ones that typically angel investors understand really easily. I think that clinical decisions, obviously you want clinicians and physicians and hospitals to make better decisions. So if you can make it very relatable to, and if you're looking at early stage angel investors, angel groups, then the more that you can communicate the easiness of making that SaaS solution a true problem solver for that entity that you're going after, that customer, that ideal customer, that's when that gets a little bit better for the investors. Right now, investors, of course, we've already said 1,000 times, due diligence is longer, but that searchability of hey, is this an investment good for my thesis? Is it clear to understand? Can I actually explain it to my buddy over here, my investor buddy over here, so we can co-invest and syndicate? Yes. So I would say with any easy SaaS, harder SaaS is a little bit harder, right? It's hard SaaS is more ones that are more complicated. Not everybody can completely understand it. That's a little bit harder to understand and it's harder to syndicate. And then healthcare. Healthcare is always going to be around. Again, long sales cycles, right? So how can you circumvent that? How can you, as a founder market fit, lessen that sales cycle? Do you have a really great advisor that you brought on board? There's a lot of risk mitigation pieces to make sure that you are indicating that you're decreasing the time between right now that you're talking to an investor and first revenue. Okay. Oh yeah, Stephen just said that there's another I'm doing this series every month so that we can just get some really boots on the ground, like what I'm seeing, what is out there. Investor outreach and communications is next. So, and it also, if you need to meet with me and go through your list of investors, I do better when you, I mean, Kabir knows me really well. If you have a list, let's go through that list. Let's see where you're at, see what I know, what you know, and we work on it together. But there are some tried and true things that all entrepreneurs should be aware of, and that's that next session. So, and it's like 2 more minutes. Any other questions? No? Okay, I'm gonna go after the most frustrating thing for entrepreneurs to finish up. As I said it's at the very end, is that kicking the can down, right? It's like moving the goalpost. Who's felt that, right? Like everybody in entrepreneurship. Yeah, I know the goalposts. It's something that is hard, right? And I would say like three things that I usually tell all entrepreneurs is like seek the clarity that you don't have, right? So like if they're like, "Oh, you need to come back to me when you have that revenue." You're like, "Okay, since you're really great experts in that industry, could you let me know who you can introduce me to get me to that next goalpost, right? Seek that clarity, right? Yes, Kyle.
Yeah, first, thanks so much, Celia. Appreciate it. And talking about kicking the can down, I think there's one of my experiences is getting so much feedback from different sources, and then like, you know what? I need to pause for a minute. And now AI is like advanced so far.
Yeah,
I need to circle back to like
yeah,
the whole product market fit and kind of
yeah.
reevaluate. So like, I'm kind of in the pause, ready to jump back in, but it's like the timing is kind of along with the can being kicked down too. So
Yeah, great question. And I'm going to try my best to answer it. And we're out
yeah.
of time, but I want to make sure I answer this. No, I want to for sure. First of all, AI is going faster than you can even imagine, right? So you're never going to catch up,
Yeah.
right? But knowing it and saying I'm mitigating and I'm knowing it, that's a great conversation to have, right? With that investor, because you're never going to catch up, period, right? Secondly, when they're like, okay, you're right. When somebody's giving you so much advice, like they're like so much advice, and then you get another one, and then you get another one, you get another one, and there's different paths that they're kicking you down. You're like, are you kidding me? Like I have 5 things to do, and you're telling me to the
Mhm.
goalposts are all different. Um, you know what your goalposts need to be,
Mhm.
right? You know, for your customer that you're going after, they want it a certain way. They want the value. If you can show value, you can show revenue. And that goalpost is maybe over here because they don't know their customer. That investor doesn't know your customer as well as you do. Get to that revenue stream, get to that goalpost that is um, a inflection point, right? So there's different like words right out there: goalposts, goals, inflection point. I like inflection point because it's like, okay, I'm going. I have might have a goal of like, I don't know, 1,000 customers, but that really doesn't mean anything. That inflection point doesn't get reached until you get to 2,000 let's say customers or downloads, because that's when I'm going to turn on premium and that's when we're going to get revenue in.
Mhm.
That's the inflection point. And that's what
Mhm.
any investor is going to love, is that inflection point of something revenue wise, partnership wise, that you're able to like really scale in a way that they can't tell you that you don't have that um that traction. They might
Mhm.
want more, okay, I'm sorry, right? But you will say, look, I went after that goal, that goalpost. I got there because of these things. I'm the founder market fit. I know my customer, and not arrogantly, right? I know you, so it's like I know you wouldn't do that, but like something like that, and say, hey, I've arrived at there. Let's talk about that. Are you willing to invest now? Or do you
Mhm.
still want me to just have a conversation with you? And they're like, well, you know what? We're out of money, blah, blah. You're like, okay, I'm going to put you on my tier 2 list of investors, and I'm going to go forwards to what I think I can accomplish with the investors that are, linked arms with me and my advisors that are supporting me. So it's a little bit of having your own confidence to go forwards, but the awareness that things are going fast. They are
Yeah.
going to kick it down, and you're going to do the
Yeah.
best thing that the best way that you can. So, okay,
Thank you.
cool. Okay, thanks everybody for coming. Thank you, Kabir, for your thank yous. Okay, see you guys later. Bye.